And we are back. Make sure your cameras are on, please. All right. Cameras, bring your cameras back on. Thank you. All right, so guys, we're going to talk about the role of Fannie Mae, Ginnie Mae, and Freddie Mac. First of all, these are the biggest players in the secondary market. Okay, so they operate in the secondary market. They're the biggest players. That means they're the largest purchasers of loans in the secondary market. Okay. Let's start talking about Fannie Mae. Now, Fannie Mae is a government-sponsored enterprise originally organized by privately owned corporations. So they were a huge group of investors. So, Mr. Badur, you were asking about private investors. Fannie Mae, Federal National Mortgage Association, was never federal. Never. They just put federal as a name, right? Which is funny because a few years ago, I opened up a company which I wanted to call Federal Debt Assistance Bureau. That was the name of it, Federal Debt Assistance Bureau. And Federal was not allowed for me to open up as Federal. So it still became Debt Assistance Bureau. Sounds very professional, right? And I called it .org, so even better. An organization for helping people not to lose their homes because of these people. Anyway, long story short, Fannie Mae is not federal. They are privately owned, but now it's government-sponsored enterprise because they were bailed out in 2008, 2009. They had two huge bailouts. Okay, they almost went underwater. And being the largest purchaser and the oldest on the block, I call Fannie Mae, I call her Grandma. She's the oldest on the block, so everybody listens to what Grandma has to say, right? That's the power that Fannie Mae had. So government needed to bail them out, or the economy would never recover. Okay, between Fannie Mae and Freddie Mac. So, as a secondary market player, what Fannie Mae does, if there's a question in the school or state exam, what they do is buy loans. They buy. They don't originate. They buy loans. It could be conventional loans, FHA-backed loans, or VA-backed loans. They give banks mortgage-backed securities, right, in exchange for blocks of mortgage. They offer lenders firm loan commitments provided that they conform to Fannie Mae's lending standards. I'm going to go over this in a second. And they sell bonds and mortgage-backed securities, and they guarantee payment of interests and principal on mortgage-backed securities. So, let's talk about Grandma for a second. When I said that, the reason why I call Grandma Fannie Mae again is because everybody listens to Grandma. They don't listen to the parents, but if Grandma comes along, the kids listen, right? They do whatever Grandma says because Grandma's the coolest in the world. Isn't that the way it is? Nobody ever listens to the parents, right? So, Grandma here, Fannie Mae, what Grandma does is Grandma goes around and says, this is the type of loan that I want. And what the kids do, so Bank of America, Wells Fargo, Chase, and so on, what they do is lend money to you based on whatever grandma says. Okay? Based on whatever grandma says. So grandma says, hey, loans 640, no more than $500,000 for a single family, no more than $1 million for multifamily, and their income ratio has to be X amount of dollars, whatever. So they stipulate whatever they're willing to purchase. And by saying whatever they're willing to purchase, because they're the largest purchaser, right? By stipulating whatever they're willing to purchase, all lenders adjust to whatever Fannie Mae says. So the point here is very simple, and I'm going to give you another example. The point is very simple. The reason why you get denied a loan sometimes is because you don't meet Fannie Mae's guidelines. Your loan is not sellable. You guys understand? Your loan is not sellable because there's nobody that wants to buy. So the alternative, when you get denied for a loan, there's two alternatives here. One is improve your credit and your income, whatever the issue might be that did not qualify for them, right? Number two, go for a portfolio lender. Credit unions, for instance, loans and savings associations, small banks. Most of the times they intend to keep it in-house, portfolio lenders. So if they deny you because you don't meet Fannie Mae's guidelines, right, go to a different lender. Interest rate could be a little bit higher, sure, but they're a little looser in the regulations. Now, again, what does this mean? Lenders adjust to Fannie Mae guidelines. What it means, again, is let's picture this. I'm your investor, right? And I go, let's see who's here. Francesca, I'm your investor. And I'm going to tell you, look, Francesca, here's the deal. As an investor, I invest in anything as long as it makes sense, right? But pretty much I only have one rule, right? And the rule is any house that you bring or building that you bring to me, any house or building you bring to me must be green. So the color must be green. Francesca, how many properties would you bring to an investor that says no limits as long as you meet this guideline, green? How many properties would you bring to me? And guys, you can help out in that answer as well. How many properties? I'm your investor. I'll buy any property, any type of property, as long as it's green. Okay, I'm still looking for the right answer. It says all the green ones, as many as I can, a lot. Okay, cool. Still waiting for the right answer. These are not incorrect, but there's one answer that I know it's going to pop up. That's going to be the best answer ever. How many green properties would you bring? I mean, because all I want, that's the only requirement I have, is that it's green. Shanice says unlimited, but Shanice, there's limited amount of green properties. One. I'll buy any property, right? I have unlimited amount of money. I'll just buy properties. You're only going to bring me one. Your first answer was a little bit better. 5? Okay. The ones that qualify, so that's the ones that are green. What about the ones that are not green? What about the orange houses, the yellow houses? You would not bring them to me? Come on, somebody has to have the answer. Paint them. So up to 2008, guys, the reason for the crash. Up to 2008, originators, Countrywide, Wells Fargo, Bank of America, Washington Mutual, right? All these lenders at the time, they were painting the loans or making the loans seem like they met Fannie Mae's guidelines. So they were telling Grandma, I know you're going to buy all our loans. These are all loans that meet what you want, but Grandma doesn't see that clearly anymore. She's old, right? Wears glasses now. So Grandma said, sure. I said I would buy them as long as they meet my standards. And if you, grandson, tell me, or granddaughter, tell me that it meets my standards, I'm going to accept that answer. So back then, that's exactly what happened. They bundled a bunch of loans, pretending to be loans that met Fannie Mae's guidelines. And Fannie Mae bought a bunch of them. Again, being the biggest player of stimulating that economy, right? Those type of products on the market, right? Being the biggest player when they went underwater because of this, of these adjustments that the lenders made, right? That's why it crashed, okay? So they were bringing all the loans that met the guidelines. And then under the rug, they're putting a few more loans that did not meet the guidelines, but because the majority met the guidelines, they were okay with it. You guys understand so far? You guys good? Okay. So Fannie Mae, grandma, sets the standards and everybody listens to grandma. Remember that. They buy conventional FHA or VA-backed loans. Pretty much they buy anything, as long as it makes sense. Okay? Grandma's shady. No. Grandma's not shady. By the way, Ahmed, you're Egyptian, right? Said that? Yeah? Okay. I had a student in my previous class. His name was Shady Sharif. I was always messing with him because he was kind of shady. You know? Not only that, the guy that referred him works with us. So Mac referred and says, listen, you can mess with Shady all day long. Because I always tell Mac over here, and I'm sorry if anybody gets offended. I always tell Mac when he comes into the house, into our office, he always has a shaved head and has the beard, right? And I told him, every time you walk in, I get scared, man. I don't know, because you come in with all this power, you go like, boom, another listing. I don't know, boom, I get scared. That's the way we live in this world now. So he says all the time, listen, I referred this guy to you, I referred that guy to you, mess with him as much as you can. I do it all the time. Ironically, Sharif means honorable. So Shady Sharif. Shady and honorable in the same set. Wow. That's so messed up. How'd you guys come up with these names, man? Terrible. At least mine means brown. Simple as that. Which is always ironic as well, because I'm not brown at all. Anyway. This world is so crazy, we gotta have fun. We gotta just, make fun of the situations. All right, so we got Fannie Mae out of the way. Now it's the baby. Ginnie Mae. Ginnie Mae is the baby. Why? First of all, it's the only one that's government. It's the only one that's really government. The other ones say federal, but they're not federal at all. It's the only one that's really government. And they were created to assist with high risk and low yield mortgages. So they were created at the time of the bailout to help deal with all these high risk mortgages. Okay, so it's the baby, it's the newest kid on the block, Ginnie Mae. So what you got to remember about Ginnie Mae is high risk mortgages. That's what you need to remember, high risk mortgages. Hey Brandon, I got your message. Hope everything's okay. All right, next we got Freddie Mac. Just wanted to acknowledge his message. Freddie Mac. Now the other ones are easy to understand why Fannie Mae and Ginnie Mae. This one, FHLMC. How does FHL goes into Freddie, right? MC, I understand Mac, but FHL goes into Freddie. But this is Mac Daddy over here. It's the big daddy. They buy a lot as well, like not as much as Grandma, because Grandma's been around, so it has more power. But they buy mortgages and pull them and sell bonds backed by mortgages in the open market. So they also buy the loans. Lula's asking, what is a high-risk mortgage? Okay, if your credit score is below 620, you are called a subprime risk. So any loan that was given to people that were with a credit score under 620, right? So the lowest would be 580. At one point, they were giving 540. So if you had a 540 score and you had a pulse, boom, you got a loan. Congratulations. All right? Those are high risk. Why? Because if you cannot, that's the way they see it. If you cannot manage your credit, right? And that's what the credit score is for. If you cannot manage your credit, how can we rely on you for a mortgage, right? So you become what's called a high-risk mortgage, okay? That's the easiest way to explain. All right? Now, over the next hour, more or less, we're going to talk about conventional loans, FHA insured loans, VA guaranteed loans, and we'll talk about your initial question, Ahmed, about the 20% on the PMI and all that. We're going to talk about it here. We're going to talk about common loan structures, seller financing, and special purpose loans. Any questions before I move forward? That goes under FHA. I didn't forget the FHA 203K. I told you once we get to real estate financing, we'll talk about it. All right, so whoever's watching on YouTube, you can also ask questions. Let's talk about conventional loans. So an easy way to remember conventional is traditional. A traditional loan is you come to me and I lend to you. Simple. Traditional loan, right? So a conventional loan is a traditional loan between lender and borrower only, okay? So that means that FHA and VA are not involved. So a conventional loan is lender-borrower directly. No outside influence. Okay, if you want to write that down somewhere, is lender-borrower directly. No outside influence. Again. Please. What else do you want me to repeat? All right, so Zelina asked for me to repeat again. And she was nice enough to put please, not like other people that just say repeat. Right? Very rude. So I appreciate you, Zelina, for being so nice. So what I was saying is that conventional loans are traditional loans. It's between the lender and the borrower directly. No outside influence. Lender and borrower directly. No outside influence. Okay? Next. Market rates usually determine the interest rate on the loan, and because of the lack of insurance or guarantee by a government agency, the risk to a lender is greater for a conventional loan than for a non-conventional loan. The risk is usually reflected in higher interest rates and stricter requirements for the down payment and the borrower's income qualification. So, Bank of America is not an example. The type of loan from Bank of America is an example. Because Bank of America can give you an FHA loan and a VA loan. Okay? Conventional loan simply means it's Bank of America's guidelines versus FHA or VA guidelines combined. Okay? That's the only difference. So, what was I saying? Okay, so with a conventional loan, usually they ask for more down payment, and your restrictions in terms of income and credit qualification are also different. You need to have a higher credit score, higher income for you to get into a conventional loan, right? Because it's bank's guidelines. So let's say Bank of America in your example, Bank of America lending directly to you without any third-party influence, it's called conventional loan. At the same time, conventional loans allow greater flexibility in fees, rates, and terms than do insured and guarantee loans. Okay, so even though interest rate might be a little higher sometimes, right? They might not have as many fees or as high fees as the FHA or VA loans. Kinda. I'm going to address that in a little bit, Ed. Not all government workers are entitled to FHA. Okay, but there's FHA programs for government workers. But I'll get to that in a second. So the primary sources of conventional loans are banks and savings and loan association. Other lenders include credit unions, life insurance companies, pension funds, mortgage bankers, and private individuals. We already talked about this. Various types of lenders specialize in mortgage lending for specific purposes. Type of borrowers, such as commercial, construction, single-family, residential loans. Okay. So now let's talk about FHA loans. So conventional loans are out the door. Now, FHA loans. So FHA insured loans is the correct term. Why? Because FHA does not lend money. FHA is the Federal Housing Administration. They do not lend money. They insure money. Okay, so they're an insurance for who? The lender. Not for you. Okay? So the lender still lends to you directly. So as I was addressing Lula's question before, the example, Bank of America. Bank of America can give you an FHA loan. All it says is that the government, Federal Housing Administration, is insuring Bank of America to lend to you. And that's why usually we have lower down payments, right? Like FHA loans traditionally are 3.5% down payment. So very, very low instead of a 20% down payment. But FHA insures the lender for that difference. You understand? So whatever would be the ideal down payment, let's say 20%, right? So 20% is the ideal down payment. If you're putting 3.5%, then they're insuring 16.5%. What does that mean? It means that if you stop paying, the lender automatically can qualify for 16.5% difference. Automatically, they can qualify for whatever the difference of what you put in and what you should have put in. You guys got it? Good so far? Yep. All right. MIP, not PIM. MIP. PMI is for conventional. PMI is for conventional. MIP is for government loans. Right? If you guys remember this, PMI and MIP. Okay. But yes, if you put less than 20%, so Ed, you're correct. If you put less than 20%, they'll ask for MIP. Very similar. Easy to get confused. And that is why in the real world, and I say real world, not book world, right? In the real world, we say PMI for everything. Incorrect, right? But we say PMI for FHA and for VA, for conventional. So it doesn't matter, right? But the correct term is MIP. All right. Now, here's what we have. Federal Housing Administration, or FHA, is an agency of the Department of Housing and Urban Development. It does not lend money. It does not lend money, but insures permanent term loans, permanent long-term loans. It insures. Sorry, just 1 second. Give me 1 second, guys. All right, sorry, guys. All right, so again, FHA does not lend money, they insure money. Joel, PMI have to be MIP. No, it's just PMI means private mortgage insurance. MIP means mortgage insurance premium. So mortgage insurance premium is what you have to pay. Okay, it's what you have to pay. It's the premium you have to pay for an FHA loan. It's the insurance premium. Mortgage insurance premium. Because it's insurance. Okay? Where the other one, PMI, private mortgage insurance, remember, as we were talking about here, because there's lack of insurance or guarantee by government, right? They have to find a private company. Let's say you own a company, and the bank, sorry, and the bank would tell you, hey, Joel Insurance Company, would you insure this loan? Right? So you're a private lender, private insurer, I'm sorry, private insurance. So therefore, PMI, private mortgage insurance, by Joel Insurance Company instead of FHA or VA. Okay? If it's an FHA, it's already an FHA insurance. So all you're doing is paying the premium, mortgage insurance premium. Technically, they're the same. It's just different terms because one is private, the other one is government. Okay? That's all it is. So again, the lender must be approved by the FHA. So for you to lend FHA loans or FHA insured loans, you must be approved by FHA. And the borrower must meet certain FHA qualifications. In addition, the property used to secure the loan must meet FHA standards. So what we're trying to say here is, not only you need to qualify under FHA, but the house as well. There's limits of values. There's limits of rooms. There's limits of square footage that FHA has. So you cannot have a 10,000 square foot house under an FHA loan. Okay? There's a limit. There's a limit of how many rooms you can have. You cannot have 10 rooms, okay, under an FHA. The house cannot be over $1 million, as an example, as in an FHA. So they set their limits, and these change all the time. So that's why you need to be up to date with your lender and figure out what the programs are available, right? What programs are available. But these could change over time. The limits for the loan, the limits for the purchase, the limits for the credit, the limits for the income, they all change based on FHA standards, okay? What you need to remember is that the FHA ensures, right there, that the lender will not suffer significant loss in the case that the borrower stops paying or defaults. To provide this security, FHA provides insurance and charges the borrower with an insurance premium. Insurance premium, okay? So FHA loans typically have a higher loan-to-value ratio. That means they give you more loan, right? More loan and lesser down payment, okay? Than conventional loans, enabling the borrower to make a smaller down payment. Now, the basic FHA insured program is Title II, Section 203B program for 1 to 4 family residential. Okay, so Mr. Badura keeps on insisting on a 203K. Okay, 203K is Title II, Section 203K. Of FHA standards. Title II of FHA talks about mortgages, and under these mortgage loans or insured loans, they have different variables, different programs. 203B usually is what we consider the first-time home buyer program. It's a 203B. But nobody says, oh, I want a 203B. Nobody. I want an FHA loan. This is the most commonly used because it's for the 1 to 4 family residential properties, okay? FHA loan, the most common is it's the 203B for 1 to 4 family properties. And I do this. Because if you can get into a government-sponsored program, which most people would qualify for, right? The majority of people qualify for. If you can get into the first-time home buying, and no offense if you already got a one family out of this, right? Single family. But if you're a first-time home buyer, why would you waste the opportunity? Why would you waste the opportunity to come in with a low down payment? Very low down payment. Why would you waste it on a single family where you can have an income property? Income generating property. So you put a little bit of money and you get a lot of bit of money. Okay? A little bit of money and you get a lot of bit of money. This program is intended to home ownership, but it also gives you an opportunity to freedom. Just saying. Okay, why waste it? I always, 9 out of 10 people that talk to me about buying a single family, I convert them to this. 9 out of 10. Okay? Why 9 out of 10? 9 out of 10? Because there's always that one person that is stuck on, I don't want neighbors, I don't want tenants, I want my house and not have to have headaches of the toilet is not working, or electricity has a problem, or whatever. And I understand that, and I respect that. Just that a multifamily pays for those expenses if you do it right, if you invest it correctly. Okay. Denise, how much are they requiring now for conventional loans? It's anywhere between 15 to 25%, always have been. Depending on the lender, especially now with the COVID, they have the COVID fee. So they'll charge you, actually they call it administration fee. So they'll charge you an extra fee, which will lead you almost to the 25%. Okay, so be ready for 20 to 25% when it comes to conventional loan. Okay, now FHA mortgage insurance. Let's go back to this again. FHA determines how much mortgage insurance must be provided and charges the borrower an appropriate MIP, mortgage insurance premium, MIP. Okay, so for FHA, it's called MIP. A lot of acronyms, I know, a lot of them. For FHA, it's MIP, it's mortgage insurance premium. Now, the initial premium is payable at closing and is added to the borrower's loan balance and financed. So you have options, paying up front or rolling into the loan. Most people roll it into the loan, the MIP, right? Further, annual premiums are charged monthly. The amount of premium varies according to the loan term and the applicable loan-to-value ratio. So, Ed, I think you said 350. The other day you said 300? Okay, so $300 for the MIP. Some people pay $250, some people pay $400. It all has to do with the loan term. It has to do with the loan-to-value ratio. So how much are they lending to you, right? And that will give you your MIP, your premium, your insurance. Okay, so everything is based on the value. If you default, if you stop paying, FHA reimburses who? The lender. The money doesn't go to you, it goes to the lender, because you stop paying, lender gets paid. It's to cover the lender. That's why the lender's comfortable. It says, well, if you don't have 20%, we don't need as much because the government will bail us out if you don't pay. That's pretty much what this is. Okay? One of the things I don't like about FHA loans, one of the things I don't like for the borrower side is that the property must be appraised by an FHA approved appraiser. What does that mean? It means that if you're dealing with a buyer, okay, if you're realtors, if you're dealing with a buyer that's FHA buyer, okay, and the property that you put an offer, if you did not check the value of that property, okay, that's why I always ask my realtors here. I always ask them, are you sure the property is worth it? Do you think it will appraise? Don't put an offer based on whatever they want. Like, because I can put a listing at $1 million. If the property is worth 500, FHA will say it's worth 500. So if you come in with an FHA buyer to a property that's not worth it, right, it will most likely be denied because they will not lend. They will not lend up above the appraisal. Okay, what they'll lend is the LTV against the appraisal. Okay, so with that being said, let's say you have real quick. Let's say you have a property that you're buying for $100,000. Okay, and the bank says, actually, let me put 102. So this is the purchase price, $102,000. But the bank says, hey, appraisal is $100,000. Okay? You're buying it for 102, but appraisal is 100,000. And LTV is 96.5%. What does this mean for you? Okay? If the LTV is 96.5%, that means they're giving you 96.5% loan to value, and the value is the appraisal. This is value. Okay? So that means that the down payment is 3.5%. What is 3.5% of 100,000? Okay? 3,500. This is what you have to come up with. Well, but Bruno, what happened to the 2,000 over there? The bank will lend you based on this, the 100,000. So you still have to come up with a difference, plus $2,000. So how much is the money you have to bring at closing? 5,500. The loan allows you 3.5% down payment of appraised value. You have to come up with a difference. So when it comes to this, a lot of people walk away, right? For two reasons. One of them, barely anybody likes to pay for overpriced stuff, right? If you're buying for 102 but it's only worth 100, hey, seller, drop 2,000 because it's not worth it, right? So you walk away because it's not worth it. Or number two, usually if you're getting into an FHA loan, it's because you don't have enough money or enough credit to get into a conventional loan. So do you think they're going to have the extra $2,000? In this case, it's simple numbers, right? Very short numbers. But sometimes we're talking about $5,000, $10,000 difference. I had one case here that was almost $20,000 difference that the appraisal came in at, and the deal was at 670. Appraisal came at 540 something, almost 550. If the buyer really wanted, they would have to come up with an addition besides the down payment, right? On 640, the down payment was 3.5%, so it's a hefty down payment, right? Besides that down payment, they would need to come up with an additional $20,000 in order to close. What do you think they would do? They would walk away. You guys understand? So it's very, very important. This feature right here of the FHA loans is very, very important you guys understand. And for VA loans, it's the same thing. If it does not appraise, and this will be an addendum, it's something that's added to every purchase agreement that says, Mr. Seller, we're putting an offer subject to FHA. Okay? And that addendum says if the property does not appraise, or if it does not meet the FHA standards, the buyer is not legally bound by any contract. The buyer can walk away. So this is where my question comes, and I'm giving you a little bit of the training that we give to our agents. This is where the question comes, right? Should you have put an offer on something that you do not know the value? Aren't you misleading your client by not knowing the value of this property and saying, yeah, let's put an offer at 670 when the property is worth 650 or less, right? So it's very important that you guys understand this concept when you have an FHA buyer. They usually are limited in money, right? Therefore, do not bring them to overpriced properties. Okay, it's as simple as that, right? You'll forget all this until you get to the actual contract, but at least for now, I'm giving you the heads up. Okay. Next, maximum loan amount. FHA has set maximum loan amounts for over 80 regions. Okay. Borrowers within the region are limited to the loan ceiling amount in effect in that region. In addition, the maximum loan amount is restricted by loan-to-value ratios in effect. The maximum FHA-backed loan a borrower can obtain will be the lesser of the regional ceiling amount or the amount dictated by the loan-to-value standard. And calculations are based on a lesser sales price or appraised value. So I just explained this part. The point is, if you're in Texas, as an example, if you're in Texas, the FHA loans there have different limits than the FHA loans here. An FHA loan here could go up to 600,000, 634, I think it is, right? But one in Texas would go up to 400,000 because the values there are also different. You understand? So it's not, FHA is not standard across the board. 80 different regions have different values. Okay. Down payment requirement, as I said, the minimum down payment is based on the lower of the appraised value or sales price. So that's what I just explained right here. Okay. And the present requirements. The present requirements for single family residential loans is 3.5%. Okay, Brendan. So 3.5% is your down payment for FHA loans for now. Okay, that's the present requirement. That means it could change at any time. Now, you put the power, listen to me, you put the power of 3.5% with the current interest rates, and you're going to waste it on a single family? You see what I'm trying to say? 3.5%. Interest rates are less than 3% right now. It's a no-brainer. It's like free money. You can buy a multifamily income property with almost free money. It's a no-brainer. All right? These are things that I use to convert, again, 9 out of 10 potential buyers. The other thing is I'm helping you for the future because I'm helping you guarantee you don't default. Think about it. If you lose your job, like, hey, pandemic, right? If you lose your job, who's going to pay for the mortgage? It's as simple as that. You want to go for a single family? Sure. If you lose your job, who's paying for the mortgage? In the multifamily, right? I'm going to repeat all this in investments tomorrow. But in the multifamily, you don't have that issue. At least the risk is reduced. You assign the risk to your tenants because they're paying the monthly mortgage, hopefully. All right, does this make sense? All right, cool. And some of you are like, my single family, what am I going to do now? Oh my God. Yep, I got one right there, smiling. 2, boom. Do it. So here's the thing. There's good news. Depending on how many years you've been in that property, you might qualify again for an FHA loan. There's still an opportunity for you to move to another property. Okay, but having a good MLO or loan officer and a good realtor will help you. So if you guys need a realtor to get out of your current situation, let me know. I'm licensed. It's a joke. It's a joke. Okay, I don't do that. Actually, I don't. Actually, I've had students ask me, Bruno, help me buy a house. Like, sure, you're getting licensed in a couple of months, so I'll help you buy a house, but make sure you use your license towards the down, so that money goes towards the down payment. It helps you. I don't want the commission. I want you to do it. Right? I prefer that you guys, if that's your first deal in real estate, right? That's great, because then you get to go through what buyers go through. You understand? So you understand as a realtor what you have to prepare for your buyer. So that would be great. All right, let's see. Just a few hints, by the way. Daniela, if you already bought a house in an FHA loan, can you buy another property in the same? Okay, I think I just addressed that. You might be able to. Yes. If I buy a house that needs a little arrangement with FHA, how long do I have to live in it if I want to sell it later? Great question. Traditionally, 90 days at least if you're going to do a profit. If you're selling, refinancing is a different story. But to sell and you want profit, usually Fannie Mae guidelines are at least 90 days. At least. Some have changed to at least 6 months. Right? So you have to know the type of loan that you have. But in as little as 90 days. That's if you want to have more than 15% profit. If you buy for 100,000, you want to sell for 120,000, that's 20% profit. So now within the 90 days. If you're selling for 110, next day if you want. Okay? But again, it varies, the programs vary. Joel, how many years you can apply for FHA loans? I'll talk about it later. I cannot give it all to you. I have to keep you in suspense for a few things. Otherwise, you quit the class today and go get your loans done, you know? It'll be in installments. Master never reveals all the tricks at once. Denise, drop gems, bro. All right. You know it. You know how I roll. All right, so next. Diana, puppies are extra. Same. I charge extra for puppies on camera. I cannot get adults on camera. I get puppies on camera. Look at that. Anyway, and Richard, kids, it's quadruple. Next, prepayments. You know, have her brother here. Oh, Shanice said, oh, look. Shanice just put on camera. You guys see it? Diana? The brother saying hi. There's a puppy there saying hi. Your dog. All right, let's see. Edwards, I bought a multifamily FHA. If I sell, can I buy FHA again? Are you still in an FHA loan? That's the question. Ed, are you still in an FHA loan, or are you in a conventional? Still in an FHA? Yes. Okay. So you cannot have two FHAs at the same time. Put it like that. So if you sell it, would you qualify for another FHA? Possibly. Yep. If you refinance to a conventional, could you keep both? One conventional and one FHA? Possibly. I'm not going to say definitely yes, because again, every scenario is unique. You need to sit down with a loan officer that will help you figure it out, right? If you need recommendations, you already know, you can always reach out. Kelly's recommendations don't work. I'm just letting you know. Here in-house, we have great loan officers that can help you. Joel's laughing too. Anyway, going back to prepayment. What is prepayment, guys? What is prepayment? Obviously, is paying sooner, right? Paying earlier than what was determined. So if you have a 30-year, I know you know Kelly. She told me, by the way, Joel. She told me that she referred you, and I told her that I was going to recruit both of you and her sister. Joke, just a mess. All right, so prepayment is paying sooner or earlier than predetermined. So if we said it's a 30-year loan, then it's expected that you pay for 30 years. But just like credit cards, do you borrow money from your credit card and just pay the minimum? If you do that, then big mistake. It's costing you a whole lot of money for you to just send minimum. You always have to send a little bit more. If you treat your mortgage the same way, then you could prepay in less than 30 years. So you pay sooner or earlier. If you finish paying it off earlier, they cannot charge you for FHA loans. They cannot charge you penalties at all. You can prepay. If you win the Mega Millions tomorrow, if you somebody says, Bruno, I have here $100,000 to pay off your house. Pay me at 1%, right? Somebody says something like that, I can go and pay off my loan right away. If I've been on that loan for 1 week and I pay off the loan, no penalty. If I've been on that loan for 10 years and I pay off the loan, no penalty. If I've been on that loan for 20 years and I pay off the loan, no penalty. For FHA loans, right, there's no prepayment penalty. Write this down somewhere. For FHA loans, there's no prepayment penalty. Okay? And the reason why I'm saying FHA instead of all loans, because then it depends by state. So I'm in the state of New Jersey. In the state of New Jersey, there's no prepayment penalty on any mortgage. But other states might have it. If it's FHA, there's no prepayment penalty. Danielle, is that the same as a balloon payment? No, but we'll get to balloon payments. We'll get there. Okay? Just don't want to mix it right now in this section. Assumability. Assumability is you have a great loan, but you cannot afford to pay the house anymore, or it's not sellable right now. Okay? So you're going to reach out to me and say, hey, Bruno, would you like to take over my loan? Like, make the payments for me, right? I take over your loan, I live in your house, and you move on to a different house. So if the bank allowed this to happen, we contacted Bank of America and say, hey, Bank of America, I'm going to be the new borrower on the house. I'm going to buy the house. Is it okay if I take over the loan? Okay? If they say yes, then I assumed the responsibility of the loan. Okay? Instead of being under your name, it's now under my name. That's assumability, assuming the loan. Okay? One thing to remember, interest rates have nothing to do with FHA, they have to do with the market. So FHA does not get involved in the interest rates. All they do is say down payment requirements, housing requirements, and all that. Interest rate is the market. Okay? Points, we talked about points already, but points, fees, and costs, the lender charges those fees, right? So here's the APR thing that comes in. Discount points, loan origination fees, and other charges. These are by the lender, not FHA, not VA. Okay, these are fees charged by the lender. Okay. However, if the seller pays more than a specific percentage of the costs normally paid by a buyer, the FHA may regard these as sales concessions and lower the sales price on which the loan insurance is based. All right, in addition to Section 203B, FHA offers insurance coverage for other loan products. Okay, so the 203K is K for construction. That's obvious. K for construction, like cars for kids. You guys heard that jingle before, right? I know it's now playing in your minds. 1-800-CARS for kids, right? Cars with a K. And they also take boats and airplanes if you have them. Just the average person might have it. But anyway, so 203K is the other most common one. But there are subsidized loans for low and middle income families. There's loans for condominiums, loans for multifamily projects, graduated payment loans, and adjustable rate loans under FHA guidelines. Okay, under FHA guidelines. So there's a lot of different, there's the B, there's a C, the D, and so on. There's different lines or sections of the 203 section, right, of Title II of the Federal Housing Administration. So there's different types of programs. Okay. Every time you see 203K, it's the only one. It's the only type of loan that we say 203K instead of a construction loan. Okay? It's the only type of loan we say 203K, but it addresses improvements or construction. Do you have a specific question regarding 203K? Ahmed? Okay. Because here it just touches briefly what it is. The conditions are the same. It's just now there's construction part. So they ask for additional stuff, like estimates from approved contractors. That's pretty much the difference, and that's why it takes a little bit longer to close 203K than it takes to close a 203B. Okay. All right, the next one we have is VA. VA guaranteed loans. Notice the difference. The previous one said insured, FHA insured loan. Here it says VA guaranteed loan. So the Veteran Affairs or Veterans Administration guarantees the bank that if the borrower defaults, they will pay. So it's not an insurance, it's a guarantee. It's a government fund that's set aside for the veterans. Okay? So the Veterans Administration or Department of Veterans Affairs, right? So VA offers loan guarantees to qualified veterans. So not everybody qualifies for it. Not all veterans, not all government employees qualify for it. The VA, like the FHA, does not lend money. What they do is guarantee. So who lends the money? Bank of America, Wells Fargo, but under the VA guidelines. Okay, under VA guidelines. Now, if the borrower defaults, the VA reimburses the lender for the loss. So the same thing that we just talked about for FHA. Hold on just one second. Okay. So, Tanya, I see your message right now. And sorry, a question just came through, totally unrelated to this, but I know this question has been popping up in the state exam. So, the ADA law is under the ADA law, is a landlord responsible for fixing the apartment to your needs? What do they have to fix? Do you review this in any of your videos? So if you're looking at the Dearborn version of the book, which I have also on my YouTube channel, I have a playlist there. Go to chapter 12, which is leases. Okay, and under leases, I talk about that. If you're looking at this version of the book, I believe it's chapter either 24 or 25, which talks about property management. But ADA only applies to commercial. Okay, it only applies to commercial properties, not to residential. So ADA they don't require you to fix the property to the tenant's needs. What the ADA requires is that if it was easy and cheap to do, why didn't you do? That's what the ADA requires you to do. So always look for a couple things. Are they talking about commercial? If they're talking about commercial, ADA applies. If the answers are residential, then it does not apply. Okay, so that's the first thing to look at. If they're talking about having to change, restructure the building to put an elevator, that's expensive. It's not feasible. It's ridiculous. I don't have to change the whole building because of one person in a wheelchair. And this is not discrimination, right? Discrimination would be I have a parking lot and I don't have handicap parking. That would be discrimination. I have an elevator, right? And I don't have auditory signals or braille markings for somebody that's deaf, okay, or somebody that's blind. I'm sorry, okay. So ADA just requires, so Americans with Disability Act just requires that in commercial properties, if it was something that was easy and could facilitate the life of somebody with a disability, right, to get into the building or access the building, right, if it was easy, right, reasonably achievable, so financially achievable, why didn't you do it? That's how you get sued in those types of deals. Okay, so I hope that answered your question, Tanya, and you're welcome to chime in and ask more questions whenever you want. Okay, Lula, is it before or after a person moves in? I'm sorry, I lost you on that one. Thank you, Tanya. I appreciate it. Glad you do, and I hope it helps you. Lula, could you develop on that? I'm sorry, I'm lost on that question. So if you know the person has a disability moving in and needs a ramp, you have to. So okay, so let's look at this. If it's a commercial property, right? Commercial property, so 5 units or more. If it's a commercial property, was it accessible for me to put a ramp right away and consider people that have disabilities? Should I have done it already? Those are the things that are going to pop up in court. Do I have to do it? No. But at least I have to have something that would facilitate, like a ramp that I can put on or remove at any time, if that's my concern. A $400 ramp, just put it on, remove it. I can do that. Do I have to now put it in because somebody's moving into the building that has a disability? Well, now it becomes a potential requirement, right? The person could act in bad faith and say, well, they knew that I was handicapped. They knew, so they should have provided. Or they could say, hey, I never requested it. So a tenant, whether in residential or in commercial, a tenant can request certain accommodations. A tenant can request, even in residential. The difference is in residential, I don't have to do it. I can do it, but I'm going to tell you, Lula, you pay for it. I will do it. I'll do the whole construction to adjust to you, but you'll pay for it. I'm not required to. Does that make sense? In commercial, it's a little different. If you ask for it, I must have it. If it's something that's reasonably achievable, something that's low cost, okay, should have been done. Simple as that. Okay, for new constructions, they already come with all these recommendations because the Americans with Disability Act is not that old. But for new constructions, it already comes with all these recommendations in the plans. You got to have a ramp here. You got to have handicap parking spaces here. Oh, you got an elevator. You have to put these buttons there. The auditory signals. You got to change the way the doors open and close. That comes in new construction. In older constructions, we need to see how much is it going to cost to provide that. If it's reasonably achievable, yes, it has to be done. Okay, simple. All right, and again, Tanya, if you're still there watching, again, that's the answer. If it's reasonably achievable, it should be there for commercial, not residential. I think the question in the state exam includes residential as a question that the landlord has to do it. No, landlord does not have to do it. Landlord in a residential can do it, but can put the charge towards the tenant. Okay, right? Cool. Moving forward on mortgages, Tanya. Now we're going to go to mortgages. For VA, we have the same requirement as we have for FHA, requirement of appraisal. So if the property does not appraise to the value that's being requested, right, then the borrower has the same obligation. Okay, has the same obligation. All right, I have a hello from Boo Animates. Hi, Boo. I don't know who it is, but hi. So as I was saying here, the appraisal for VA is called a Certificate of Reasonable Value, or CRV. You can remember CRV in the state exam. All right, I call it the Honda. That's the appraisal. Honda CRV. Okay, remember, Certificate of Reasonable Value. Okay, and again, if it doesn't meet, then the veteran could back out of the deal because it's not appraised for the value, or come up with a difference. That's their responsibility. As far as down payment requirements, the VA usually requires no down payment. Isn't that cool? If you're a veteran, thank you for your service. No down payment, go ahead and buy a house. Great. No money, right? And look, all you have to do, literally, is get a certificate of eligibility from the Veteran Affairs. And you can use this no down payment. You can use this no down payment, zero down. Let me put it here. Zero down to invest in your single family. Right? You can put the zero down to invest in your single family. Isn't that the best thing? Low interest rates, zero down, we're going to go for a single family. No. Sorry, the investor will not allow you to make that mistake. If it's zero down, it's free money for you to get into an investment property that will pay you for the rest of your life as long as you have it. Okay, so take advantage of that. And, see this? Depending on the loan, you might get up to 40-year mortgage. That means really, really low payments. Okay, depending on the loan. If it's a farm, and I'll talk about that later. If it's a farm, which could have that house there as well. Right? That's could be later on, your single family later on. Could be a farm. Because yes, you can get into more than one VA loan, meaning just like FHA, you end one, you can open another one. Okay, with certain limitations, but you're able to rinse and repeat, zero down. Okay. Prepayment privilege, the same thing. You can pay it off early. Assumability, interest rates, points, fees, and costs. The lender may charge same thing as as FHA. The only difference right here is that instead of a down payment, the VA loans might come with a funding fee. A funding fee is a really small percentage, almost like the PMI or the MIP. Almost like that. It's a small percentage that says, hey, we guarantee the loan, but pay us this amount towards the closing. That's it. Okay? You guys good so far? All right. Any questions? Whoever's watching on YouTube, if you have questions, drop them now. Okay. All right. So next thing we have, and it's going to be very, very brief here, is common loan structures. So common loan structures. So there's different variations of structures for interest rate, term, payments, principal payback, and these produce a number of commonly recognized loan types. Among these are the following. Amortizing loan. What is an amortizing loan? It could be defined in several different ways, but amortizing, let's start with zooming in. Amortizing, I don't know if you guys remember this or not, but okay, that word. You guys remember mortgage? Right? I separated into two words, right? One of them was mort. Okay? What does mort mean? Let me know. Death. Correct. And if you guys remember under mortgage, I said it was a death pledge, right? You pledged your property as security until something dies. What needs to die? What needs to die? The contract. Okay. Yes. Mortgage. What does it mean? The liens. Thank you. The loan. Until the loan dies. Till the death of the loan. Okay. So amortizing is killing the loan. Mort the loan. Killing the loan over time. So when we borrow money, let's say over 30 years, 300,000, over time, it's going to die down, right? Big principal, and over time, you're paying until the balance reaches zero. This is called amortizing. It dies over time, killing it over time. You guys got it? Okay. So if it's an amortizing loan, never zero. Yeah, eventually it reaches zero. If it's an amortizing loan, if you refinance, will never be zero. But if you pay it off, it will be zero. But anyway, so amortizing loan is a loan where the balance reaches zero. Slowly reaches zero. All right. So the other thing I want to show you guys real quick, and this is, again, I like to do stuff for fun, right? I just want to show you something. Some of you might have noticed already. Mort means what? Death, right? What about this that I just highlighted here? Love. You see how close they are? Like one letter apart? Isn't that crazy? Love, death. I love you to death. There you go. Crazy, isn't it? Fun facts. All right, I just like to do this. All right. All right. So that was amortizing. Love is death. Yeah. You can die for love. Yeah. So amortizing means gradual repayments. gradual repayment of principal and interest over the term of the loan. The borrower's periodic payments to the lender include a portion of the interest and a portion of the principal. So in a fully amortizing, that's the difference. There's a fully amortizing mortgage. The principal balance is zero at the end of the term. So in a fully amortizing mortgage, if your first payment was $1,000, okay, 30 years later, your final payment is $1,000. So every month you paid $1,000, and that was enough to amortize the loan, to bring the loan to zero. This is called fully amortizing. That means the loan payments are constant over time. Okay, loan payments are constant over time. We're talking about principal interest. I'm not talking about taxes or insurance, because those vary based on your municipality, okay, or insurance based on your insurance company. But principal and interest in a fully amortizing loan, principal and interest never changes. Okay. The next thing we have is partially amortizing. Okay, this is also known as a balloon. I told you I was going to talk about it. Balloon mortgage. So, I did something wrong here. Okay, that's great. All right, balloon mortgage. So partially amortizing is a balloon mortgage. So why partially amortizing? That means the payments you are making are not enough to bring the balance to zero. So at the end of the loan term, okay, at the end of the loan term, there's still a principal balance to be paid off. So your payments, all right, let's do it here. You borrowed $300 for 30 years. Your payments, instead of being $1,000, your payments are $800. It's the same $300,000, right? So if in one it takes $1,000, if in one takes $1,000 to reach a balance of zero, do you think $800 is going to cut it? No. At the end of 30 years, your final payment, okay, it amortizes like this. And your final payment is going to be an amount here somewhere. So let's say your final payment is $100,000. Okay? Because there's a balance that's not amortized. We only amortize a portion of it, not all of it. The payments are not enough for the balance to reach zero. So your final payment is $100,000 as an example. Or not to be that drastic, I'm going to put less. Okay? I'm going to put $20,000. Okay? So you guys can relax a little bit. Now, the fact that this is more than the average payment, the fact that this is more than the average payment, makes this right here be called a balloon payment. Why balloon payments? Because it's an inflated payment. It's more than what you're paying every month. Okay? It's an inflated payment. Balloon payment. It did not pay off completely. So you still have a principal balance at the end of 30 years. Now is a good time for questions. Why is it called balloon payment? Because it's a larger payment. It does not pay enough to amortize for the balance to reach zero. Balloon payment. Throw me questions. YouTubers, throw me questions. Zoomers, questions. Can you pay the balloon payment early? Pretty much is sending extra payments towards principal. That's all it is. So you have $800 every month for principal and interest, right? And you send them an extra $200 a month, let's say, towards principal. You got to be very clear that you tell the lender that that money is towards principal. Okay? And that will amortize on the principal only. So at the end of 30 years, could that 20,000 be zero? Sure, if you're sending money towards principal. Why would somebody do a balloon payment? So instead of having a 100-year mortgage where the payments are very, very low, you're going to have a balloon payment because it doesn't fully amortize. And then we always hope, right? We always hope that as you're paying it down, the value keeps on going up. So at one point, somewhere here, can you refinance and get out of that balloon instead of having to pay a whole 20,000, 100,000, 200,000, whatever? Can you refinance and keep your payments low 20 years from now, right? So balloon is just a strategy for you still getting into a mortgage, but with lower payments, and then later on refinance and keeping those same payments. It's just an alternative. What type of loan is this? It's a balloon loan. It could be conventional, it could be FHA if they allow it, but mainly a conventional loan. Okay? If FHA has a program that allows this stuff, it'll be an FHA loan. The thing is that it's a balloon. It doesn't fully amortize. This is a structure. It's not a type of loan. It's a structured loan. Just like adjustable rate mortgages or interest only that we'll talk about later. Joel's saying never do that. Save the 200 and reinvest that money in the next home. I'll tell you what I usually tell everybody that wants to refi to a 15-year mortgage, for instance. Some people refi to 15-year, and you can bring me anybody to prove me wrong. Anybody to prove me wrong. And I'm going to prove you from A to Z that I'm right. Okay? Very simple. I don't like 15-year mortgages. Yes, you can pay it sooner, but you have a higher monthly payment. That means your budget changed drastically right there, right? That's the first thing. You're going to pay less interest. You're going to pay less interest, yes, but maybe $20,000, $30,000, max $50,000 difference on an average loan. So a $500,000 loan, let's say. So over 30 years, 15 years versus 20 years, you're saving $50,000. Let's say, worst case scenario. Thinking about your concept right now, think about your concept of putting the $200 into the next home. I would put the $200 into, this is just an example, into an annuity, into an IRA, into a solo 401k, into a life insurance product that gives you 8%, 9% returns. So many other strategies. But I would invest the difference, yes, the $200, I would invest in a product like life insurance for 30 years of $300,000. So not only protects you if you die, protects you by paying off the mortgage, right? If you die, it pays off the mortgage and your surviving spouse or your kids don't have to worry about it. But also it accumulates cash to eventually pay that off or give you an additional return for retirement. So you're using the $200,000 to invest for retirement. Can you invest in another property with $200? Probably not. So why would you save that money towards the next property? No, put it in a program that beats inflation, like not savings account, definitely not. We just went over that in the first half, right? But put in a program that beats inflation, right? Gives you the returns. So for me, a 15-year mortgage or a fully amortized mortgage, if we can get into a 100-year mortgage, partially amortized, and you're just conscious enough to use the difference and invest in something. Look, you're paying 3% right now, 3% interest rates. If you put that difference, the $200, into a product that gives you 8 or 9%, right? You pay 3, but you're getting 8 or 9%. Think about it. It's a no-brainer, especially if it's insurance. Because now it already tells you there's the face value of $300,000 that covers the mortgage in case something happens to you. Insurance, for instance, life insurance, for instance, a particular type of life insurance, for instance, has a flexible premium that if you're unemployed, like right now, it happened. You can reduce the amount of payment they have to make, or if there's enough cash value, it will cover the premiums, and maybe there's enough money to keep up with the payments of your mortgage. You can withdraw from the insurance towards this. No questions asked. You see what I'm saying? So there's so many things you can do with that difference. Why would somebody do this? For me, the lowest amount of payment possible, I'll do it. For the longest period of time, I'll do it. If this month I can put $5,000 into this, I would. Next month, especially us self-employed, next month I don't know if I have money, meaning if I'm going to close. So I want to have the lowest payment possible. You guys understand? Use the difference towards an investment, a secured investment, because this is a secured property. Look for a secured investment. You can make risk investments, high risk investments somewhere else, but here you want a secured investment. So Daniela, I think I just answered one of the benefits, right? Lula, people I knew did that. From 30 to 15? Yeah, because you're paying $1,000. You go to 15, now you're at $1,800 or $2,000, almost double. Yeah, no, that's ridiculous. Today you have money, tomorrow we don't know. 2020 was a great example of safety nets, how important safety nets are. If things change drastically in your life, are you ready? If you lose your job, it takes 6 months to a year nowadays to get another equivalent job at the same pay. Are you ready with 6 months to 1 year of reserves cover that loss? You know? So 2020, I think it was a slap in the face to everybody to wake up and like, oh, wow, I should have, right? Anyway. Sorry, that's my financial advisor side, talking about how to protect yourself in the future. Anyway. Next one we have, guys, and we got 20 minutes. So the next one we have is negatively, I just sound like the presidential candidates right now, rolling the tongue. So negatively, okay, amortized a loan. Well, if I told you, right, if I told you that amortized means killing it off slowly over time, right? Yes? If amortize means killing it off slowly over time, then negatively amortizing means resurrecting the debt, right? If one is killing, the other one is increasing, it's bringing back. So if it's negatively amortizing, then the balance increases instead of decreasing. Okay? Lil, I see what you wrote there. I'll address it in a second. But I just want to keep it separate, even though it could be one of the reasons, yes. But negatively amortizing, it causes the balance to increase instead of decrease. Okay? Increase instead of decrease. That means right here in a partially amortized loan, we already knew that the payment was not enough to bring the balance to zero. That's why we have a balloon payment. We already knew it's preset that over 30 years we're going to pay $800. At the end we pay $20,000. Preset. Okay. In a negatively amortized loan, they give us 4 options: to pay principal and interest, to pay principal with a little bit of pay interest with a little bit of principal, to pay interest only, or to pay less than interest. Right? So in a negatively amortized loan, if you're putting less than what's required to cover interest, see, this amortizes something. An interest-only loan amortizes nothing. A negative amortized loan amortizes less than something, or less than nothing. That means you're negative every month on your payments. You're not putting enough. And that difference, that negative difference, is added to the principal over the years. Okay? We usually find these in adjustable rate mortgages. It could occur in adjustable rate mortgages, or also graduated payment loans. Okay? So you're not putting enough, not even to cover interest. Partially amortized, we're putting something still. Interest only, we know we're not putting in nothing, so the balloon is $300,000. At the end of 30 years, I still have to pay $300,000. Negative amortized, we're putting less than nothing. And that's why it's negative. It increases the debt instead of decreasing. Okay? Sounds like bad student loans. Kinda. Yep. You guys get it? I'm going as slow as I can. Give me a thumbs up if you got it. If you have a question, ask now. Okay. Going as slow as I can. The next thing we have is adjustable and fixed rate loans. Look, as the name says, adjustable or ARMs, adjustable rate mortgages, as the name says, they are variable. That means your interest rate is not constant. Your interest rate can go up and down depending on what the market demands. So today you're paying $1,500 a month. 6 months from now, it adjusts and you might be paying $2,000 a month. 6 months later, it could adjust and you're paying $500 a month, right? And you go on this up and down. I don't know what's going to be next 6 months, right? Up and down. This is crazy. My life is going, in spiral mode right now. Adjustable. No. These are good. Adjustable rate mortgages are great, actually. These and interest-only mortgages are great for investment properties, where you're buying, fixing, flipping. Get rid of it. If you intend to live there for 30 years, right? Or actually for more than 5 years. If you intend to live there for more than 5 years, this is really bad. These are not intended for long-term loans. Okay? Not intended for long-term loans. Fixed rate are intended for long-term. Joel says, I was thinking that when you make a loan, the rate is locked since you get the loan. Correct. If you're talking about a fixed rate loan, this is locked. Yes. Yeah. But if it's a variable, they fix it for a period of time. It's called a teaser rate or teaser term, which is really just like, hey, it's cheaper than going to the fixed rate. Jump at this now. They're teasing you to get into the loan. Okay? These are really, really, really bad if you don't know what you're doing. I think anything is bad if you don't know what you're doing, but anyway. All right, I actually have a whole section, a whole explanation on adjustable rate mortgages in the YouTube channel, right? In this book, they give us a primer. They give us a separate pages. I can send it to you guys. But if you guys watch the video that I have on YouTube about adjustable rate mortgages, it explains the T. It's almost 30 minutes, 30 minutes because I go really slow and I give you different examples. But it's almost a 30-minute video on adjustable rate mortgages only. Okay? Very, very important. Talks about negative amortization, talks about the adjustable rates, caps, which is the max that they can change in the next adjustment. I mean, a bunch of things, guys. Watch that video. Definitely going to help you. Senior and junior loans. The difference between these is who came first, who came second. That's it. Senior, it's the order of the lien. Okay, so order priority. You guys already know this. Okay. Interest-only loans, as the name says, if it's interest only, then nothing goes to the principal. Interest only. Every payment goes to the interest, not to the principal. So you're going to have a balloon at the end, right here. You're going to have a balloon payment at the end of the whole $300,000 that you borrowed. The advantage, really low, really, really low monthly payments. Okay? Again, not intended for long term. Interest only, who gets it? Is that what you're asking, Lula? Who gets interest only? I do. When I want to buy, fix, and flip a property. It's the lowest monthly payment. I pay interest only, sometimes of 8, 9, even 10%, interest only, but I only use it for 3 months. 5 months, worst case scenario. Again, not intended for long term. So interest only are great, right? Construction loans, usually regular FHA 203K is not, but conventional loans, they're usually interest only. Okay, that's who gets these. So not millionaires, anyone, any-nair. Seller financing. Simplest term, seller becomes the bank. Okay, so the seller becomes the bank. Seller financing, the seller provides some or all of the financing for the buyer's purchase. Okay, so seller becomes the bank. Seller becomes the bank. They are the lender. So they're telling you, hey, without giving you any money, they're telling you, hey, give me a down payment of 10%. Okay, great. Now pay me everything else in installments over the next 30 years based on 6% interest rate, as an example. So they're the ones that extend the financing. So if I have 2 properties, I live in one and I'm selling the other, I got nothing to lose. You're paying that one at interest. That means at the end of 30 years, I almost doubled my money, right? For you, it's great because the bank would not lend to you because of your credit, because of your job, because of whatever, right? But I was okay with it. So a seller financing is like a creative arrangement between the seller and the buyer only. No banks involved, okay? Next, we got purchase money mortgage. As the name says, it was financing to give you money to purchase. This type of mortgage was a mortgage to give you money to purchase. I'm sorry, Lula. Is there a list of what? List of seller financing? What do you mean? Sellers that do financing? Yeah, okay. So it's not exactly a list. It's people are doing for sale by owner, or for instance, that's usually the most common. For sale by owner, they've had difficulty selling on the market, or they're trying to save or make more money. And you go to them and say, hey, apparently you're not in a rush to sell, right? Here's my proposal. So pretty much any seller could do seller financing if they're not struggling, right? So if it's somebody that needs to pay off a mortgage, right, they need to pay it off, then it's tough. Can you find out, is there a list, and now you want me to give you the, like all the magic beans here? Can you find out who are the sellers that would most likely be willing to do seller financing? Yeah, you can get that list by finding people that supposedly have equity. So there's a few searches that you can do. You can buy lists from you can buy lists from for instance from Experian, from Equifax, TransUnion, and they'll tell you in the information most likely to have equity. Okay, because a seller that has equity is the one that would most likely get into these type of arrangements. If they have no equity or limited equity, they need to pay off the bank. You understand? So they will not go into these arrangements. Joel's asking, is this like lease option? It's very similar. It's seller financing, where lease option is seller becomes the landlords temporarily. But it's very similar. It's your arrangement directly with the seller instead of with the bank. Okay, wraparound mortgage. Here's another one. The wraparound mortgage, I also have a video on YouTube regarding wraparound mortgages where I illustrate, but it's very simple. Remember I just said you need to have equity to do seller financing? Okay. Sometimes we have equity, but we still have a balance, and you giving me the down payment, you're not paying enough for me to pay off the bank. So the arrangement I do with you is, hey, buyer, right? I'll finance the purchase, but I'm not going to release the title yet because I still have to pay Bank of America, and you're not giving me enough to pay Bank of America. So what we'll do is your mortgage will wrap around my mortgage. So the property now has two mortgages, right? The one with Bank of America and the one that you have with me, right? So there's two mortgages involved. So your mortgage wraps around mine. So you pay me and I pay the bank. You pay me, I pay the bank. Okay? So I become the middle person here. I receive from you, the buyer, and I pay the bank from that money. Okay? So usually in a wraparound mortgage, and again, I encourage you to watch the full video because I go very slow at it. Very, very slow explaining and illustrating how it works. But in the wraparound mortgage, it enables a buyer to obtain the financing with minimum cash investment. It also potentially enables the seller to profit any difference between the lower interest rate on the senior, because I pay Bank of America at 4%, but I would charge you 6% on yours. All right, so I'll make that difference as well in interest rate. Okay, so again, watch that video. Very, very important if you want to get into wraparound mortgage, if you want to understand how it operates. For state exam, one of the things you need to remember is wraparound mortgage means two mortgages on the property. The buyer mortgage with the seller and the seller's mortgage with the bank. That's what you need to remember if the question pops up. Okay. Contract for deed, it's like a layaway, kind of, right? So I usually call it similar to car financing. So that's what I would write here. And I mentioned before under contracts. But a contract for deed is you pay in installments, right? And this is different from lease option, because lease option, you're leasing with option to buy later. A contract for deed is you're paying financing, so you're paying principal and interest instead of a lease or rent. You're paying principal and interest, but you only get the deed at the end. So similar to car financing. Because in the car financing, you only get the title when you finish paying it off, right? Same thing. You only get the title when you finish paying it off. Contract for deed is also known installment sales contract or land contract. So the seller is the owner of record, on the property, so the legal owner, while you have equitable title. You guys remember equitable title? Raise your hand if you remember equitable title. Okay, so there's a difference between legal title and equitable title. Legal title, the property is under my name. Equitable title, you're paying. So you have equitable value into the property. Okay? So as a buyer in this scenario, you have equitable title and possession of the property. I have legal title as a seller while you're paying me. And then at the end, once you finish paying it off, I will transfer or convey the property to you. So you only get the title at the end. Okay? Next thing we have is special purpose loans. So right here we're going to talk about real quick about home equity loan. Okay, I already talked about it before, so it's not going to be very in depth. But home equity loan is when you're taking like a second mortgage and you're cashing out on the property. So they give you a loan based on the equity that you have. I really don't like home equity loans because for me, home equity loan, for me, they are hell. Okay? What I like, right, and Joel spoke about it earlier, what I like is home equity lines of credit, because these are very similar to credit cards. I can borrow money, but I don't have to take all the money. Hell, home equity loan, I take all the money and then I have the obligation to pay back, even if I don't use the money. Okay, that's the risk. You're paying back even if you don't use the money. Where a HELOC, home equity line of credit, right? You borrow if you need, and you pay on what you borrowed, just like a credit card. If I take $10,000, I pay back interest based on $10,000. If I see a house that I can buy now, right, for $60,000, fix it and flip it later, I'm going to use $60,000 from the HELOC to buy that house, fix the house, pay back the HELOC. Boom. Profit, 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 profit. So I use one property as an example, one property, and that HELOC gives me a bunch of properties. You guys understand? The HELOC gives me a bunch of properties. Why? By leveraging either for purchase or for the rehab of the property. The money's there. Okay? That's what HELOCs are great for instead of a home equity loan. Package loan. As the name says, package. So it's a package deal. That means you're getting the purchase of real estate and personal property. So real property and personal property. So let's say you get into a condominium, which is the most common scenario for package loans. You get into a condominium that's fully furnished, right? And that's the display one. And you're like, wow, I like this couch. I like this appliance. I'm in love with everything here. Can I have this exactly as it is, right? If that's what you liked, you go to your lender and say, hey, lender, I want to buy this for $100,000, this condo, $100,000, but I need an extra $20,000 to get the furniture that comes with it and the appliances. Okay? If the lender says yes, they made a package deal. Therefore, package mortgage or package loan. So every time you see package deal or loan, it means you're buying real estate and the personal property, the furniture, everything that comes with it. Thumbs up on this? Okay, great. Construction loan, you guys already know. It's for construction purposes. Bridge loan. So bridge loan is, as the name says, it's a bridge. So it's to connect 2 points, right? Because a bridge connects 2 points. What points is exactly connecting, right? So this is purchase and sale. Actually, reverse, I'm sorry. Sale and purchase. You're trying to sell your property, right, in order to be able to purchase another property. So we're going to put a contract that says, it could be usually for construction loans, but in this example, for you guys to understand, I'm going to say I'm going to put a contract to purchase this property with a condition or contingency that I sell my property. So I'll purchase, but hey, buyer, seller, you understand I need to sell my property in order to buy yours, right? If you're getting close to the period of time and you still did not sell your property, one of the things that you can do is a bridge loan. We're going to connect these 2 points. Okay? A bridge loan is a no more than 6-month loan, interest only. But it helps you connect the 2 points, allowing you to buy this property as you're still selling yours. Hopefully yours does not take an additional 6 months to sell. But again, the idea is to connect the 2 points. It's called bridge loan, interim financing, swing loan, right? Pretty much interim loan. It's something that's in between period of time. I'm helping you connect the dots. Okay? Thumbs up? Great. Okay. Participation loan. So in a participation loan, usually it's insurance companies or sometimes lenders themselves that participate in this type of deal. All we're saying is I'll give you the loan in exchange for all or part of equity in the property. So I'll give you the loan, but I become part owner of the property with you. Okay? So I'm the lender, but I become co-owner somehow of the property. Participation. Again, usually insurance companies. Takeout loan is for construction, is when we're going from the construction loan we want to convert to a permanent or long-term loan. That's a takeout loan. Okay. And this one right here, guys, I know we're going a couple of minutes over, but I had good questions, right? This one right here is called reverse annuity. Reverse annuity because it pays every month or every year, depending on how you structure. But this is called reverse, most commonly known as reverse mortgage. Have you heard of this? Reverse mortgages? Okay. A reverse mortgage, if you guys want to take notes, a reverse mortgage is where the bank pays you instead of you paying them. So they created an annuity for the rest of your life. They pay you. Annuity. The rest of their life, they pay you instead of you paying them. Okay? Now, that's right, Lula. This is not available for everybody. I wish, right? I get into a mortgage where they pay me, and I don't have to pay them for the rest of my life? Sure. The thing about reverse mortgages or reverse annuities is that usually they are for senior citizens. They're on fixed income. So they tap into the equity that they've built over time in order to get the bank to pay them instead of they pay the bank. Okay? Blanket mortgage. Blanket mortgage, to keep it simple, is for subdivisions or developments. So subdivision or developments. So it covers the whole land that you just bought, and as you cut it into pieces, it allows you to sell them individually without activating what's called alienation clause. You guys remember alienation or due on sale clause? Right? So that means that once you sell the parcel, once you sell one of the parcels or piece of land, once you sell it, the bank has the right to say, give me my money, right? You cannot sell to somebody else without paying off the bank. In a blanket mortgage, which is only for subdivisions, okay, in a blanket mortgage, they allow what's called a partial release. Instead of give me back all the money, give me some money based on the sale of that one parcel or two parcels or three, right? So again, blanket mortgage is strictly for subdivisions or developments. All right, if you guys want more information regarding specific loans, you have all the links here, as it says. And we are done. Let me know if you have any questions. If you don't have them today, tonight, tomorrow, throw me questions. Watch the videos on mortgages. Like I said, I have adjustable rates. I know it's a long one. I told you, imagine if I did this all in one day. Crazy, right? I can, but then you guys wouldn't understand anything. Yep, Denise, I know. But anyway, watch the videos definitely on YouTube. If you have any specific question, I'll create a video breaking it down more in detail if you want. But just let me know. All right, guys, I'm here for you. I want to help you succeed. Today, 2 of my students passed the state exam. I was very excited, right? Especially one that was forced to move to Texas, job relocation, and still came back after 6 months to take the state exam and passed today. So very excited about it. All right, and I wish the same to you guys. Not that you move to Texas, but that you pass. All right, so ask me questions. I'm here for you guys. Have a great evening. Thank you.